So maybe if I start with the natural catastrophe experience, for the industry, there in fact was a large load of losses that came through in the first half of the year. The reality is most of these storms, thunderstorms, hailstorms, in some cases flooding associated with that, affected primarily the primary industry, not the reinsurance industry. And so we at Swiss Re, along with many other reinsurers, had relatively light loads for the first half of the year. We don't necessarily expect this to continue, but we were happy to take the benefit in the first half. We also took advantage of the situation to reinforce some of the reserve positions we have in our book, given the fact that those losses were relatively modest for the first half. On the investment income, we continue to reinvest our portfolio. We have a duration that is somewhere between 5 and 7 years, depending on the line of business. And as the old bonds roll off, we reinvest into higher interest yielding instruments in the fixed income portfolio. That continues to help us and delivered a return on investment for the first half of the year of 4.0% for us. That's the largest return that we've had probably in a decade. And lastly, in addition to the low Nat Cat, our disciplined underwriting has avoided some of the losses that we might have seen in previous years, where the reinsurers in particular were taking a large proportion of industry losses on the chin. I think we're in better shape today, and we'll continue to be disciplined about the risks that we take on a going forward basis.
Very clear analysis there. Let me just come to the P&C renewals. This you call a successful July here, a 7% volume increase with the business, but overall price increase of 8% on P&C Re around this renewal round. We've been trying to speak to a lot of the insurers to get a sense of where some of the pricing is going when it comes to insurance. We know it's been one of the elements that's been adding to heat in the inflation numbers. What are you witnessing from the reinsurance aspect of this business?
So again, we were actually very pleased with the July renewals, an 8% price increase, year to date 9%. So there's been a little bit of modulation, but only a little bit. As we go forward, we expect that people will continue to see the need for the increase in the loading for cost. Inflation has lessened, but it's not gone away. Our model changes, especially around the Nat Cat side, where we see increasing damage from these convection storms and associated flooding, mean that we have to price a higher expected loss for the same sorts of geographies that we had a lower price in 2020, 2021, 2022. And as we do that, these price increases, frankly, are needed as we continue to go forward. The primary industry, I think, now understands this. We're reaching a new level of equilibrium where they're able to get improved rates on their side to be able to pay for the reinsurance that's required to cover the risks that we assume.